Jessica made $84,000 a year as a senior account manager. Solid income, good credit, stable career. On paper, she was exactly the kind of person banks claim to support. When she walked into her bank to request the $25,000 small business loan, she wasn't chasing a fantasy. She had already signed 2 consulting clients paying her $3,000 a month on the side. She had demand, she had projections, she had a plan. The loan wasn't for luxury. It was for transition, runway, and basic infrastructure so she could leave her job and scale. Within 18 months, she realistically expected to earn $150,000 per year. 3 weeks later, the same bank mailed her a pre-approved auto loan offer for $38,000 at 6.2% interest. No business plan, no audited projections, no collateral. Just her W-2. She could walk in tomorrow and drive off the lot. The bank said no to the asset that could triple her income. They said yes to the liability that would lock her into monthly payments for 6 years. Banks don't fund potential. They fund predictability. Here's what most people misunderstand about lending. Banks are not evaluating your ambition. They are evaluating your stability. A business loan requires belief in your upside. A car loan requires proof of your paycheck. From their perspective, an employee earning $84,000 with a fixed salary is predictable. They know what hits your account every 2 weeks. They know roughly what your expenses are. They can model your risk. An entrepreneur who might double their income in 18 months, that's uncertainty. Banks optimize for predictable repayment streams, and predictable repayment streams come from people who remain dependent on their jobs. A successful business owner might not need financing for lifestyle expenses. A leveraged employee with car payments and credit card balances definitely will. One customer grows independent. The other remains structurally tied to the system. Guess which one is more attractive to a lending institution? The salary ceiling illusion. Everything in the modern lending model reinforces one quiet assumption. Your salary defines your financial limit. Mortgage approvals are based on income multiples. Auto loans depend on income ratios. Credit card limits expand when you get promoted. Your earning capacity is treated as static, not expandable. Total consumer debt in the United States has surpassed $17 trillion. Nearly all of it is structured around predictable salary income. That isn't accidental. The entire system is built around the idea that your job is permanent and your growth is incremental. The moment you start asking, can I afford the payment, instead of does this build wealth, you've shifted from wealth builder to payment manager. That shift is subtle, but it's powerful.
Consumption is easy. Creation is difficult. Walk into almost any bank and you can access tens of thousands of dollars in consumer debt with relatively little friction. Car loans, credit cards, personal loans, home equity lines, all approved quickly if your income fits the model. Ask for capital to build something income-producing, and suddenly the gatekeepers appear. Documentation, collateral, proof of history. The barrier to consumption is low. The barrier to creation is high, unless you already have assets. Because consumption keeps you predictable, creation changes your trajectory. If you use $40,000 to buy a car, the car depreciates and you keep your job. If you use $40,000 to build a profitable service business, you may eventually leave your job. The system is comfortable financing your upgrades. It is far less comfortable financing your escape. The real math nobody talks about. Let's run basic numbers. Imagine you make $90,000 per year. A bank may approve you for a $300,000 mortgage, a $35,000 vehicle, and $40,000 in revolving credit. That's hundreds of thousands in debt tied to your current salary. Now, imagine you request $50,000 to build a consulting business that could generate $5,000 per month in profit within a year. That's $60,000 in additional annual income. Your earning potential jumps from $90,000 to $150,000. But the bank hesitates. Because if you succeed, your income is no longer capped by your employer. Your financial life becomes less dependent on traditional lending products. Your risk profile changes. Your relationship to debt changes. Predictable borrowers are profitable. Rapidly evolving earners are harder to model. And institutions optimize for what they can model. How the programming happens. The most dangerous part isn't loan denial, it's psychological conditioning. Most high earners don't even apply for growth capital. They assume their salary defines what's reasonable. They upgrade homes after promotions. They upgrade cars. They expand lifestyle. Their spending scales with income. Credit limit increases arrive right after raises. Approval emails show up right when you feel proud of your new salary. The system quietly expands your liabilities in sync with your income growth. So no matter how much you earn, you remain stretched near the edge of affordability. You feel successful, but you're also maximally leveraged. And once you structure your life around fixed payments, risk-taking becomes terrifying. You can't leave your job. You can't take a pay cut. You can't experiment. The cage becomes invisible because it feels comfortable. Jessica's long way around.
Jessica didn't take the auto loan. She kept her old car. She built her consulting practice at night and on weekends. It was slower than she wanted. It was exhausting. But 2 years later, she went full-time. Today, she earns over $230,000 annually. She has employees, she owns equity. Her income is no longer capped by a salary band. Recently, the same bank that denied her growth capital called to offer wealth management services. Now that she has assets, they want to manage them. They declined her when she needed leverage to build. They welcomed her when she built without them. That's the cycle. The lifetime interest strain. According to Federal Reserve data, the median American household pays hundreds of thousands of dollars in interest over a lifetime across mortgages, car loans, and credit cards. Interest isn't inherently evil. It's the cost of borrowing. But when most of your borrowing funds depreciating assets, that interest becomes a silent wealth transfer. Every dollar in interest is a dollar not building equity, not compounding, not expanding ownership. Over decades, the difference between leveraging for assets and leveraging for lifestyle compounds dramatically. The real question. This isn't about blaming banks. They operate within incentives. It's about recognizing those incentives and adjusting your own strategy accordingly. Stop asking only, "Can I afford this?" Start asking, "Does this increase ownership or obligation?" Separate lifestyle debt from strategic leverage. Automate wealth building before lifestyle expansion. Treat your salary as seed capital, not a ceiling. Your paycheck is the current market rate for your time. It is not the maximum value you can create. If you structure your life around predictability alone, you remain predictable, and predictable borrowers are easy to manage. If you build assets that generate cash flow independent of your job, you become harder to control financially. That shift changes everything. If this made you look at your salary differently, good. The goal isn't to reject banks. It's to stop letting them define your limits. Use the system strategically instead of being structured by it. If you found value in this breakdown, subscribe for more deep dives into how money systems actually work. Drop a comment if you've ever felt like your income was a ceiling instead of a starting point.